Welcome to This Explainer. Today, we're diving into an absolute ticking clock thriller. We're going to look at how a single hedge fund nearly brought down the entire global financial system back in 1998. We're talking about the spectacular rise and the truly devastating fall of long-term capital management. Ultimately, this is a story about what happens when unquestioned absolute brilliance meets unimaginable risk.
To really understand the absolute stakes of this crisis, I want you to consider this staggering number, $553 million. That is the exact amount of money long-term capital management lost on a single Monday. I mean, just think about that for a second. In percentage terms, this one-day drop wiped out a massive chunk of their remaining equity, leaving the entire fund teetering right on the absolute edge of survival.
So we're going to explore the frantic, almost unbelievable few days where fierce Wall Street rivals were literally locked in a room by the Federal Reserve and essentially forced to pay up just to prevent a global financial Armageddon. It's truly absurd when you think about it.
Section 1. Bleeding Billions. Okay, let's dive into this by starting right in the middle of the chaos. This is when the fund's brilliant, Nobel laureate-designed mathematical models began to violently, inexplicably fail. By mid-September of '98, long-term's equity had plummeted to just $1.5 billion. They were bleeding cash at an alarming rate, taking brutal daily hits. $145 million on a Thursday, $120 million on Friday, $122 million the following Wednesday. Honestly, it was like a biblical plague. Meanwhile, U.S. swap spreads, which are essentially this vital pulse check of panic in the broader financial markets, had climbed to an astonishing 83 points. Now, according to their supposedly infallible models, this was practically impossible. Yet, there they were, so desperate that they were practically begging Goldman Sachs, a fierce competitor, to step in as a savior.
As one observer at the time noted, in that 1 month, long-term had lost 6/10 of its capital, one of Wall Street's epic collapses. It's honestly hard to overstate the sheer velocity of this fall. Remember, this was a fund universally praised for its genius risk management, and suddenly they are free-falling through the floorboards of the global economy.
Section 2. The Systemic Threat.
Now, normally, if a hedge fund loses its own money, well, that's just their problem. But long-term's failure, it threatened absolutely everyone. The Federal Reserve realized pretty quickly that they weren't just looking at a localized fire. They were staring down the barrel of systemic risk. That's the terrifying fear that if long-term defaulted, its creditors would all rush to neutralize their trades at the exact same time. That would spark a vicious circle of panic liquidations, causing credit markets to just completely freeze. This wasn't just a Wall Street problem. We're talking about everyday bank accounts, retirement 401ks, and the broader Main Street economy potentially freezing up worldwide.
When Fed officials finally got to look inside the fund's closely guarded books, Peter Fisher from the New York Fed studied their top-secret risk aggregator report, kind of like a pathologist scanning an X-ray. And what he found was an absolute monstrosity of overlapping derivative contracts. The fund wasn't just highly leveraged. Its massive global trades were completely interlinked. A quake in one market would trigger avalanches absolutely everywhere else.
And that brings us to the number 17. That's the exact number of massive, interconnected counterparty banks. We're talking titans like Merrill Lynch, Goldman, Morgan, and Solomon. Together, they stood to lose a combined $2.8 billion if long-term suddenly failed. If this fund collapsed, there was no doubt it was taking the giants of Wall Street down with it.
Section 3. The Buffett Alternative. So, with global contagion looming over a deeply anxious weekend, a sudden glimmer of hope actually appeared. And it came from a really unlikely savior who happened to be on a boat in an Alaskan fjord. That weekend was an absolute blur. On Friday, the Fed inspects those dire books. By Sunday morning, they've summoned the heavyweights of Wall Street to the Federal Reserve to basically force a bailout. But then, right at 11:40 a.m. on Sunday, a surprise one-page fax comes through. Warren Buffett, who was vacationing in Alaska, suddenly offered to buy the fund himself, entirely bypassing the Fed's bailout plan.
But, as you might expect, Buffett's offer was a harsh, take-it-or-leave-it proposition. He offered just $250 million in cash to buy the fund, demanded the immediate firing of all the founding partners, and slapped a super strict 12:30 p.m. deadline on it. It was incredibly cheap, and it would have completely wiped out the firm's arrogant partners, leaving them with nothing but their pride in absolute tatters.
So why didn't it happen?
Well, ultimately, the billionaire's bid died on a strict legal technicality. Buffett's offer was mistakenly worded to buy the assets of the fund rather than the complicated portfolio company structure housed over in the Cayman Islands. Because of this beautifully ironic fatal flaw in the paperwork and Buffett's outright refusal to extend his strict time limit, a multi-billion-dollar lifeline just vanished as quickly as it appeared.
Section 4. The Wall Street Rescue. All right, so with Buffett officially out of the picture, the crushing burden fell right back onto the shoulders of Wall Street's fiercely competitive CEOs. Locked in a room at the New York Fed, these rival executives were effectively held hostage by the very systemic risk they had helped create. The mood was perfectly captured by JP Morgan's Sandy Warner, who said, "Boys, we're going to a picnic and the tickets cost $250 million. They deeply, deeply resented the price of admission, but they knew they absolutely couldn't afford to leave."
The negotiations were agonizing. Imagine dozens of thick-necked bankers, guys accustomed to ruthlessly fighting each other for every single dime, all squeezed into the Fed's soft leather-backed chairs. Firms like Bear Stearns flatly refused to participate, arguing it just wasn't their problem, while European banks stubbornly tried to lower their contributions. It was a room absolutely full of massive egos facing mutual destruction.
It's really crucial to understand just how messy this rescue actually was. It took a grueling 72 hours of non-stop legal battles involving over 140 lawyers scurrying around, basically trying to build a parachute midair. And through it all, the original long-term partners furiously resisted giving up control. They were acting with astonishing entitlement for a firm facing total bankruptcy. At one point, Goldman Sachs even threatened to walk out entirely over a dispute regarding Chase's loans. The whole deal was held together by a tiny thread and a genuine, terrifying fear of Monday morning's opening bell.
In the end, they did hammer out a deal. A consortium of 14 banks injected $3.65 billion into the fund. In exchange, they took 90% of the equity. The original partners, who had commanded billions literally just months prior, were left with a tiny, heavily indebted 10% sliver of their former empire. They effectively became hired hands, forced to manage their own unwinding.
Section 5. The bitter epilogue. So, the bailout worked. The global financial system survived to see another day. But the personal fallout, it was absolutely devastating. As one account put it, the wizards of Wall Street, who had previously been worth close to $500 million, awoke to discover that he was broke. The partners, who just months earlier were the undisputed masters of the universe, were completely wiped out. Many of them were actually forced to live off their wives' assets just to avoid total personal bankruptcy. The aftermath was basically a parade of public humiliation and massive, sprawling IRS audits. Yet, despite this totally catastrophic failure, the Nobel laureates and the founding partners remained astonishingly unrepentant. In this wild display of hubris, they adamantly refused to admit their mathematical models were fundamentally flawed. Instead, they blamed the failure on an unpredictable liquidity shortage in irrational markets. Think about that. The smartest guys in the room failed at basic risk assessment and blamed reality for not matching their spreadsheets. Meanwhile, the wider market only stabilized because Alan Greenspan and the Fed stepped in to cut interest rates twice, essentially wrapping the panicked banking system in protective bubble wrap. The ultimate irony here was the blind spot of their own genius. These partners built elegant mathematical models that relied heavily on historical data, but financial history is absolutely replete with extreme events that models deem implausible. They drove a car at 100 miles an hour, assuming the road would never, ever have a patch of ice. And when it finally did, they blamed the ice, not their own reckless driving.
And that leaves us with the ultimate dilemma of moral hazard. By rescuing the reckless just to save the broader system, did the Federal Reserve simply guarantee that Wall Street would take even bigger risks in the future? When you save the brightest minds from the consequences of their own greed, what lesson are they really learning? It's a question that entirely defined 1998, and as history shows us, it's a question we'd be forced to ask again and again. Thank you for joining me for this explainer. Keep questioning and keep learning.